What if Bitcoin's biggest threat isn't regulation, isn't inflation, and isn't even a global recession? What if the real danger comes from the past and from a technology that doesn't even fully exist yet? In 2026, Bitcoin is facing a narrative shift unlike anything in its history. Nearly 4 million dormant coins, once believed to be lost forever, are now being reevaluated by markets as a potential future supply shock, triggered by advances in quantum computing. Is this fear justified? Is Bitcoin truly vulnerable, or is the market overreacting to a theoretical risk? Today, we break down the facts. No hype, no fear, just data, protocol mechanics, and what this means for Bitcoin's long-term valuation. Market context: Bitcoin's underperformance in 2026. After a strong institutional cycle between 2020 and 2024, Bitcoin entered 2026 in an unusual position. Despite global liquidity conditions remaining relatively stable, Bitcoin has struggled to outperform major equities and select altcoins. While previous cycles were driven by halving narratives and ETF inflows, this cycle is being influenced by something different: structural uncertainty about long-term supply integrity. Historically, Bitcoin's bull thesis relied on three pillars: fixed 21 million supply, predictable issuance schedule, increasing institutional absorption. That thesis still stands, but a new variable has entered the equation: quantum computing risk applied specifically to early Bitcoin wallet formats. Markets are forward-looking. Even low-probability events can impact price if the potential impact is large enough. And this is where the ghost supply narrative begins. The ghost supply: understanding lost coins. Bitcoin's scarcity argument has always included an unspoken multiplier effect: lost coins, estimated lost supply. Research from firms like Chainalysis and on-chain analysts has consistently estimated that 3.5 to 4 million BTC are likely permanently lost. Most were mined between 2009 and 2012. Many belong to early adopters, including holdings attributed to Satoshi Nakamoto. These coins have not moved in over a decade. They include early P2PK addresses, wallets where private keys were discarded, hard drives lost or destroyed, early miners who never secured backups. This lost coin factor effectively reduces circulating supply from 21 million to closer to 17 million. And for over a decade, markets priced Bitcoin accordingly. But what if those coins aren't permanently lost? Wallet formats and technical exposure. To understand the risk, we need to examine early wallet formats: P2PK versus modern address formats. In Bitcoin's earliest phase, many transactions used paid-to-public key. In these transactions, the public key was directly visible on-chain. Unlike modern formats, it wasn't hashed before exposure. Modern Bitcoin uses P2PKH, SegWit, and Taproot. These formats hide the public key until coins are spent. That distinction matters because classical computers cannot derive private keys from public keys, but theoretically, quantum computers might. Quantum computing and Shor's algorithm. Quantum computing research has accelerated globally. Major players include IBM, Google, and Microsoft. The algorithm often cited in Bitcoin discussions is Shor's algorithm, which theoretically allows a sufficiently powerful quantum computer to break elliptic curve cryptography. Bitcoin uses ECDSA, elliptic curve digital signature algorithm. If a quantum computer with enough stable qubits exists, it could take a public key, compute the corresponding private key, and spend the coins. However, and this is critical, experts widely agree that Current quantum systems are far from capable of breaking Bitcoin. Error correction and qubit scaling remain massive engineering challenges. Estimates for such capability range from 10 to 20+ years, possibly longer. So why is the market reacting now? Because markets price probability-weighted future risks. The supply overhang scenario. Let's quantify the concern. Category: estimated BTC volume. Institutional ETF holdings 2.5 to 3 million BTC. Estimated lost/dormant BTC 3.5 to 4 million BTC. Redistributed 2025-2026 13 to 14 million BTC. The striking insight: institutional absorption since 2020 roughly equals the estimated dormant supply. If those coins re-enter circulation, even gradually, they would neutralize ETF absorption, increase effective float, and suppress price appreciation. This is what analysts call a latent supply overhang. It doesn't need to happen tomorrow. The possibility alone changes valuation models. On-chain awakening. What is actually happening? In early 2026, blockchain observers reported an uptick from Satoshi-era wallets, addresses dormant for 10+ years. However, most movements appear to be internal reshuffling. There is no verified evidence of quantum extraction. Many moves could belong to early miners reorganizing custody. Markets often react first and verify later. The narrative impact may exceed the technical reality. Bitcoin's defense: protocol evolution. Bitcoin is not static. Developers are actively researching post-quantum cryptography (PQC), quantum-resistant signature schemes, soft fork upgrade pathways. The Bitcoin development community has a track record of gradual hardening. SegWit upgrade, Taproot upgrade. Future upgrades could allow migration to quantum-resistant addresses, incentivized movement from vulnerable formats, gradual phase-out of legacy scripts. Crucially, only coins with exposed public keys are theoretically vulnerable. Coins in modern SegWit and Taproot addresses remain secure unless spent. Hardware wallet users using modern formats face minimal immediate risk. Institutional perspective. Wall Street views this differently. Institutions model risk in probability bands. Even a 5 to 10% probability of future supply expansion can reduce target multiples, long-term projections, risk-adjusted valuations. This explains stagnation more than panic. It is repricing, not collapse. The bull case: structural strength. Despite fear narratives, 13 to 14 million BTC moved this cycle without collapse. Liquidity depth is stronger than previous cycles. Institutional custody infrastructure is mature. Retail leverage is lower than 2021 peaks. The network continues to process transactions securely, maintain 99.99% uptime, attract developer research. The key takeaway: Bitcoin is facing a theoretical long-term threat, not an immediate existential crisis. Balanced conclusion. Bitcoin is not broken, but the market is no longer pricing it as risk-free digital gold. The ghost supply narrative introduces a valuation ceiling, a forward-looking discount, and a structural uncertainty. Until the Bitcoin community finalizes a quantum-resistant roadmap, this overhang will likely remain part of price discovery. However, current quantum systems cannot break Bitcoin. Modern address formats remain secure. Protocol upgrades are technically possible. This is not the end of Bitcoin. It is a new chapter where technological evolution must match technological threat. And as history shows, Bitcoin adapts slowly but decisively. The question is no longer if Bitcoin is scarce. The question is if its scarcity is permanent. And in 2026, That debate may define the next decade of price action.